venture capital business. But tell us a story when you sold a company maybe too early, or you sold it and it didn't work out so well. Give us sort of the dark side of M&A, and why did you think it was a good deal at the time? Did you think it was a good deal? So just one story from everybody. Who wants to start?
I got unlimited stories of the dark side.
All right, let's go.
I would say that, in this, I can't name names, but on the advisory side, not on the VC side, there's a death trap, and the death trap is the test. Let's prove this out. Let's do the test. Because there's two problems with the test. You have a great buyer, there's a great synergistic fit, and then all of a sudden the acquirer says, look, we really just want to kind of dabble this and prove the thesis. And the problem becomes that if it goes well, it's never a big enough sample size, so it comes back inconclusive. And if it goes poorly, you're dead anyway. So there's no way to win that scenario. You have to figure out what the core thesis is, how this is going to work. But as soon as you get caught in the endless, let's test this, let's test this, let's test this, you end up sort of going nowhere.
I think, so Michael Marquez, Code Advisors. The interesting part about M&A, I think, is that all the great ones, you always feel like you sell too early, right? You always feel like what could have been, what we could have done, getting inside another larger organization where you're dealing with other groups or other processes, you feel like you're not as efficient, even though it's still going well. So I feel like that is part of the kind of the dance that you do. Most of the time when you sell, when you know you didn't sell too early, it's probably not at a price that's that exciting anyway. But it feels like all the great ones feel like it was sold a little too early.
Like what?
I'm trying to think of some. Why don't you keep going? I'll think of a couple of names.
The safe way probably the safe way to answer this question is probably not to talk about a company that you were not actually an investor in. Okay. So I put a term sheet out on Aardvark with Max Ventilla and Damon Horowitz, who I thought were just the most amazing co-founders, the most amazing technology, just enormous potential to actually answer questions that you could not get answered anywhere else on Google or Quora or any of these places. Google made them an offer. I felt they sold too early. I thought there was still a lot of legroom there. Google made a very compelling value proposition for them, which was that on the Google platform, they could achieve the highest aspirations for their product, which even from quite apart from economics, is the dream of every great founder. The fact that that argument appealed to them, I felt, was yet another heartbreaking sign that they had sold too early.
I agree. All the great, Villi and Box, all the great ones, you can argue, sold too early. YouTube for Google, for Facebook, Instagram, you can make that argument. I think what I am always fascinated about on this topic is the risk tolerance for founders that I, frankly, as a buyer, take advantage of, which is there's a different level of risk tolerance between the VCs and the founders, and that's entirely dependent on, most of the time, the net worth of the founder. If you have a founder who have been getting by on ramen noodles for a couple of years, and you put a term sheet in front of them that's going to change their life and their kids and their grandkids' life, that's a very attractive proposition for them. And the VCs don't look at it that way, and often there's a disconnect in terms of risk tolerance, and that's usually when founders sell a little too early, and I can't fault them for it. I would do the same thing, but to geek out a little bit, it's economic theory called utility curve, which I really enjoy taking advantage of.
Yeah. That's good to know.
Can I just retort there, because VCs do realize that, and oftentimes we will let the founders take a little bit of money off the table so they can retire all the debt and buy a house and secure at least the next few years of their life, so they feel like they can go for the bigger win. But sometimes that is not enough, and sometimes you guys, the acquirers, will have a lot more cash than the typical investor is willing to let individuals take off the table. So, but we are aware of that, and we do stretch as far as we can to make that equilibrated.
And then us reporters write a story saying, founder doesn't believe in the company.
It's all one big happy family.
David, what's your answer to this?
I'm Dave Siemer, founder of Wavemaker Partners, early stage venture fund, and Siemer & Associates, an investment bank. Probably take a little different tack. I mean, as an investor, we have about 100 active portfolio companies. you definitely cry when you see one go too early. You're just like, oh, it had so much potential, and it's kind of the sexy companies. But I think actually probably an even larger number go too late. You see a lot of guys miss the windows. I've been an investor for 18 years and a banker for part of that also. And we see a lot of companies, especially in some industries like ad tech and a few others, where the life cycles are very short. And we look at them and say, okay, you're worth 9 figures. You should really look at something now. And they try to go for $1 billion or think IPO track. And I have a lot of public shares now that are not trading well. 1/10 of their issue price, and no way out. Way too many of them. So it kind of goes all directions. And the answer, what Villi, is it Villi? So Villi said, people's own personal, situations kind of dictate everything. People, we mentioned taking money off the table. That's still really only true when you're looking at companies with like $80, $100 million valuations. We're not really at the point yet where companies with like a $20 million enterprise value are getting a chance to take $1 million or $2 million off the table and put it in their pockets. So I think eventually we'll get there. I mean, it's such a moral hazard issue, but it actually would be like a necessary thing in the industry to kind of help make companies a little more, help a lot of guys that sell out too early go long, as opposed to taking the 20, 30 million from someone.
So building on the selling too late point, I mean, if I'm an investor and I see a company of mine in my portfolio, Series A, Series B, that I want to get sold, how do you sort of edge founders along? And how do you stop them from hustling you with a company that maybe isn't as good as it should be?
Which way you want to go first?
I don't know. Who's eager?
Well, we do help a lot of our companies, and usually you can only encourage them so much. I mean, some founders have the stamina, some don't. The thing we usually do if we think someone should be selling and they're not, there's never too early a point to be talking to some of your best buyers, so we just put them in touch, kind of in a biz dev level, let them start talking. If the buyers get really excited about it, and then they kind of jump over the desk and want to do something, then great. If nothing happens, then maybe you have a problem anyway. So that's kind of one side of it.
I don't think, our recommendation to companies is not to approach the problem like I'm for sale or I'm raising money or this or that. You're an entrepreneur. You're trying to aggregate resources to achieve your vision. And it's either human capital or actual capital or access to distribution channels or access to monetization, but there's always more that you can be getting, and most likely your likely acquirers fit into that ecosystem in some way. So go talk to them. Don't, as David said, don't say, if they jump across the table, great, but be developing those relationships and developing that ecosystem outside of your company versus just thinking about inside your company, where's my next round going to come from?
I think that's the most important thing. I mean, I've always been an outbound professional kind of throughout my career, so I am obviously very biased, but I always feel like that's how, you need to be building the relationships, whether that's from a business development standpoint or from relationships, from hiring, corporate development, all of that, right? And that should start way before you're looking to sell or you're looking to raise money or you're looking to hire that next executive. You should always be doing that, right? Making sure that your story gets out there, making sure that other people know about you.
As a founder, is it ever bad to talk to potential acquirers? I mean, do you see your companies give up too much to companies that are really their competitors?
I usually see them err on the other side of staying away too long and thinking that they're going to give up the secret sauce to Google or something, and they're not. They should just, so yes, there are a few that we've seen, I shouldn't name them. I've seen a couple of companies get kind of screwed a little bit where they showed something to who they thought was like a potential acquirer, great partner. That company goes silent for like 3 months and announces the same product. So we had that happen twice with one particular company.
Is there anything they should have done different, or?
Be careful of guys with bad reputations. The company has done a lot of times in the past. I won't name them, but they probably should have been a little more apprehensive of, knowing that these guys had a history of doing that and being a little more cautious and knowing a lot more about that company as they were going into it, as opposed to just kind of seeing what the business partnership could look like.
And the stage that you divulge information, right? If in the first meeting that you're meeting with a company, your secret sauce is so easily, copied, it's probably not that defensible to begin with, right? But if over 20 meetings, you're starting to get to that level, hopefully by that time, there's a trust there. And as David said, there's definitely reputations in the Valley and the broader technology ecosystem that companies that are more inclined to do that are known that way. And so you kind of know what you're getting into, right? If you're willing to do that.
Yeah. Villi, you're sitting in both worlds here. I assume people are trying to reach out to Box and bothering you about acquiring the company, and then you're trying to acquire companies. You know, when we talk about sort of protecting what you're doing, how close to the vest do you play it?
I always advise startups to err on the being more open side. As Mike said, if your idea can be copied with a conversation, then it's not that sustainable anyway. I think err on being open, err on building trust. Being open allows people to trust you and build that relationship. I've been in awkward meetings where they won't say a whole lot, and it's hard to get excited over a company when you can't really feel any chemistry with the founder. He or she is not sharing much about their business with you, and it just it doesn't go as well. So err on the open side and build those relationships early. It's hard to do a deal when you're starting from scratch without a relationship. You're buying people as much as you're buying businesses, and that takes time. So build those relationships early on. Yeah.
It's a two-way street. I mean, if you're a good entrepreneur and you're getting in to talk to Villi and Box and Facebook and Google and Adobe and whomever else, you should be extracting knowledge as well from what they're trying to do, where their pain points are. And it's amazing what information you can get back in a positive way. So Villi will probably tell you over a glass of wine later his 5 biggest pain points are this, and this. And if you want to work on those, call me back next month and 6 months and whatever. So I actually think you should be on the offense on that, not on the defense, trying to figure out what those companies need. And as Peter Thiel said earlier, if it's, as these guys said, if it's too easy, then it's probably not that meaningful anyway.
How did filing the S1 affect your ability to go after companies?
So I joined Box just 3 months ago, so I don't think it has affected ours or anybody else's ability. Remember that Instagram got acquired just a couple of months before Facebook went public. So I don't think it changes any company's ability to go out and be aggressive. I would argue, just observing Twitter, for example, I would argue that being in the public eye makes you more risk averse and be more cautious. So until you go public, I think you have more leeway to just be more aggressive on the M&A front.
Are you trying to do all your deals over Twitter direct message? Do you see your Twitter message there?
Yes, yeah.
Anyway, I suspect you won't tell me who the bad acquirers are, but what companies do you like to work with? Like, who's a big tech company that is good at buying companies?
You know, I had a really good experience with Pulse, and Akshay Kathari and Ankit Gupta founded this remarkable news reading app and service, which had at the end of, at the right point in time, I think, a number of suitors. LinkedIn ended up winning that deal, and true to their word, they did a really great job of both integrating the team, letting them remain independent within the context of a larger company, and actually allowing the 2 founders and the entire company to achieve their highest aspirations for the product, which were to expose that product to tens of millions of people. And it's rare when you see a company like LinkedIn, which at this point was public, actually take the name of Pulse and incorporate it onto their front page and have it be called LinkedIn Pulse. So it was such a positive integration that I think worked for all sides, and I think I would love to work with LinkedIn again.
For me, it's a tough question because a lot of the, being on the seller's side of things, you don't really love the buyers. End of the day, obviously you respect them. The ones that are most straightforward, even though I think they're very difficult, are kind of like the Googles, Amazon. We did a couple with Yahoo a little while ago. So it's kind of a.
Do you enter those companies at all the same points, or how do you initiate a conversation?
It really depends on the organization.
Yeah.
So. For Amazon, they're kind of top down. You start with M&A group.
Yeah.
For Google or Yahoo, you start with product. It just kind of depends. Every company is kind of idiosyncratic in how they like to operate. Some get very offended if you don't go in the right path.
Yeah.
Well, I should say the M&A guys at some companies get very offended if you don't start with them.
That's their job.
Yeah.
Yeah.
So you have to kind of know that.
The best acquirer is the one that really wants to buy your company.
Yeah.
You'll find that everything else is solved when that happens.
But generally speaking, I would say in the Valley, there's a lot more standardization around process and how things are done, especially the serial acquirers, the big guys. And they're very good at doing this, and they care about their reputation. They're good. When you get outside the no-names here in the Valley, it becomes the Wild West, and you see all kinds of crazy stuff.
I'll just echo that. I mean, I think that what I've seen with the best acquirers are the ones that have been doing it, a lot by volume. And what you've seen now is a lot of companies have been very acquisitive in the private days, right? Facebook was very acquisitive, Twitter was very acquisitive, and so by the time they're public, they've been doing a lot of deals. And so I think that what you find is that it's the hardest deals are the ones where it's the first deal they've ever done, right? They're trying to figure this out from an integration standpoint, from a deal negotiation standpoint, all of that, right? Those are always the hardest. And the companies that are around the Valley have been doing a lot of deals, and so they're usually pretty good to work with.
Actually, and following that point, we had a client that was acquired by one of the large East Coast media companies, and they asked us, how can we get this deal done fastest? And we said, hire Silicon Valley attorneys. So they actually didn't use their counsel. They hired Gunderson, and it went straight through.
Yeah. All right, let's talk about the macro environment a little bit. I mean, valuations are so high right now. I mean, maybe you disagree. I doubt it. When I was at the information, we pulled our subscribers, and pretty much everyone thinks Series A investments are overvalued or somewhat overvalued. What does that mean for M&A? Are companies too expensive to get acquired? Are acquirers waiting for valuations to drop before they buy companies?
Yeah, I'll start with that one. I mean, it's not universal. There are, some sectors, particularly like SaaS software, are incredibly hot. There are some sectors like ad tech that are not. So I don't think it's that broad. I think in general things are quite high, but there are, a number of sectors like ad tech, e-commerce, a couple others that are, that are not crazily valued. That there aren't a ton of buyers going after those assets right now.
But also keep in mind that it's not just in private companies, right? So if private companies are hot, then usually public companies are hot as well. And so you have that same momentum that public companies are looking to, how do I accelerate growth? I've been getting a lot, I've got momentum either from hiring or from the stock market or whatever. And so they're looking at ways to accelerate that as well. Yeah, they may look at this and say, wow, I wish I could get this for 50% cheaper. But at the end of the day, they've got a lot of, momentum and wind at their back as well.
I would agree with that. In fact, I would follow on Mike's point, which is that it's better to be in these environments than the opposite. Ultimately, M&A and acquisitions happen when people are optimistic about the future, particularly in tech, because they're basically building on something that they believe is going to have a substantial return down the line. And so when management teams are optimistic, they have liquidity, they're excited about the market, deals get done. When they're worried about their job and they're maybe feeling less liquid, nothing gets done. So in 2009, nothing got done. Since then, lots of stuff gets done. And hopefully we don't go back.
I mean, I think we're still having this conversation about burn rates in the Valley. It's been coming up today. I mean, how does that play into sort of moving a company towards an acquisition? Does that play any role if they have a high burn rate? And how do you sort of suss that out?
Who wants to speak to Fab? Ultimately, commercialization is the thing we just talked about. So, if it's costing you a lot to commercialize, that's unnecessary weight that a larger company may or may not need relative to the underlying innovation. So, if you're spending a lot of money, that's going to be a big bite if your buyer doesn't feel like most of what is in where that money's going is necessary to them.
I think the other simple way to think about this is everyone always asks the question, well, how do I have a great acquisition, right? How do I have that great outcome? And the short answer is build a great company, right? And so that ties back to that, right? If you have an exorbitantly high burn rate, then the capital markets are going to have to be open to you to continue to fund that, right? And that's a precarious place to be, right? So how do you build your company so that it's sustainable? How do you build it so that you're not dependent on just an M&A exit, but you can go public or you can self-finance or whatever you need to do? And the more that you're able to do that, the better the outcome will be.
Just one other point, which is to assume, let's say you have a $20 million or $30 million burn rate annually, to assume that a large acquirer, Oracle, Google, wouldn't care about that is also rather naive. Those companies are pretty rigorous, budgets are budgets, and somebody's going to have to absorb that. And whoever the sponsor is of that deal is going to have a hard time swallowing a $20 or $30 million hole. So it not only can put your company in jeopardy, but it also makes it difficult to acquire.
Yeah, we look at you see a lot of deals, and I don't know, I never thought about it quite this way, but somewhere around like $400,000 a month loss or kind of a 5 million annualized burn rate is where a lot of buyers get a lot of heartburn, even the Googles of the world and whatnot. So that's kind of a threshold amount, and depending on the industry, of course, and some things, but it's.
Say the number again.
Kind of like, say like a 5 million annualized burn rate is when things start to get, you have to have fantastic growth and a ridiculously great technology to overcome, that kind of substantial burn rate.
And a $5 million burn rate at a startup is the equivalent of 10 to 15 at a large corporation when you add all the overhead and normalize the salaries, et cetera. So, yeah.
Villi, from your seat at Box, how much do you see your role as sort of making sure the company could get acquired? Do you lobby for sort of certain policies to make sure an acquisition is possible if the company needs to go that direction?
No, that's not my job. It's not my role. I honestly don't give it a second of thought. I'm sure.
I mean, you're talking to these guys.
Well, I talk to these people, but I would be the last person they would care to acquire, right? I'm usually the first person to lose the job after the acquisition. So they're going to care to talk to Aaron and build that relationship with the rest of the executive team. I would probably be the last person they want to court.
We'll take any questions from the audience if people want. I'd love, just like, what advice would you give a founder when they're thinking about M&A? I mean, what is just a specific sort of piece of advice that they can act on?
I just gave a talk on it, so I'm happy for these guys.
Oh, yeah, sorry, we were...
Sure, I mean, I'll just reiterate the point that I said before, which is you can't get bought if people don't know about you. So it's great to be in stealth mode, but if you are looking at some point, whether it's near term or later term, to get acquired or at least have that opportunity available to you, look to build relationships. Just because you're talking with potential acquirers doesn't mean you're trying to sell the company.
My advice is if you're going to end up working with these people for the next 2, 3, 4, 10 years, make sure they're people you actually want to work with and go to work every day. And I take a lower price to do that.
Yeah, I say this to founders and actually mean it, which is all else equal, if you take our offer for the money, this is not a deal you want to do. So I would strongly encourage founders to leave money on the table to end up at that special place where they're going to be happy, than to take just the highest price. That's really important. It's not just about the money.
And kind of echoing what Mike said is, we did a little mini research project a long time ago and figured out that the companies that had the best outcomes knew their acquirers or working with them in some BD capacity for about a year before it happened. So that's, and those were by far some of the best outcomes that we kind of saw on our own portfolio or banking side. So that's how people should really look at it. If your best buyer is Google and you're not talking to anyone at Google, you're a long ways away from having to worry about it.
All right, we have a question from the audience.
There's a recent Supreme Court case that the Alice case that overturned, in essence, according to some interpretations, pretty much all software patents. Has that affected any of the tech M&A landscape? Because a couple of years ago, companies like Google were buying companies just for their patent portfolio. Now it seems like all those patents are, in essence, worthless. What are your thoughts there?
I think patents are great. We call them bling. I think they're nice. They're not going to fundamentally change, particularly for most of the companies at this earlier stage, the operating environment. I think Dig, if I remember correctly, Washington Post bought the team for $15 million or something like that, $12 million. I think LinkedIn bought their patents for $4 million. and BetaWorks bought the entire company, the rest of it, for $500K. So I think that patents are nice, they're additive, they show some protection, usually defensive. I don't fundamentally think for growing companies, if you have a great platform and cool R&D, you're doing something interesting, that has value. But the patents are nice, but not going to seal the deal.
I agree. I haven't seen any kind of change in activity based on that.
Cool. Well, I think our time's up, right? Thank you very much. Really enjoyed it.
Thank you, guys.
Great. Yeah. Thank you very much.